Welcome to this Basic Macroeconomics Revision course. I am your teacher, Nadeem Sarwar. Today, we shall discuss major macroeconomic policies in classical framework. The reference book for today's lecture is Macroeconomics Theories and Policies by Richard T. Freund. In today's lecture, we shall first have a recap of what we learned in last two lectures. Then we shall discuss fiscal policies with respect to changes in government spending and changes in taxes. Then we shall discuss the monetary policy in classical framework. So let's start with the lecture. Students, in last two lectures, we learned that classical theory of income and employment was first attempt to explain the determination of income and employment level in an economy. The classical economists assumed that there are competitive markets, flexible prices in the economy, and there is no role of the government in the economy. One of the fundamental laws called Say's law says that supply creates its own demand. As per classical economists, both labor demand and labor supply are respectively negative and positive function of real wages. And without government intervention, the labor market always remains at the point of full employment. The total output level of the economy is equal to economy's potential level. The interest rate is determined by the supply and demand for loanable funds. The equality of the two determines the interest rate in credit market. Lastly, the quantity theory of money says that money affects price levels only. Let's start with today's lecture. Students, there are two major macroeconomic policies. First, the fiscal policy, and second, the monetary policy. The fiscal policy is all about the decisions of government spendings and revenues, whereas monetary policy is central bank's policy of controlling the money supply in the economy. Students, the total spending by the government or government outlays during a period of time are classified into three main categories. First, the government purchases, which are government expenditures on currently produced goods and services, including capital goods. Second are transfer payments, which include payments made to individuals for which government does not receive any services. For example, pensions, unemployment insurance, and welfare payments. Third is net interest payment, which include interest paid to the holders of government bonds less interest received by the government. In addition, there is a minor category called subsidies less surpluses of government enterprises. Subsidies are government payments that are intended to affect the production or prices of various goods. Examples are spot price payments to farmers and fare subsidies for mass transit system. Whereas the surpluses of government enterprises represent the profit of government-run enterprises. For simplicity, we assume that government outlays are equal to government purchases and ignore the other outlays. On the other side of the fiscal policy are government revenues. The taxes are major sources of government revenues. There are four principal categories of tax receipts. First, the personal taxes, which are primarily personal income taxes and property taxes. Second, the social insurance contribution, which are levied as fixed percentage of workers' salary up to a ceiling. Mostly, the employers also contribute to this in equal amount to workers' contribution. And the third category of tax receipt is taxes on production and imports, mainly sales tax, excise duties, and custom duties. And the final category of tax receipt is corporate tax, which are the taxes on corporates' profits. For simplicity, we shall discuss the effect of change in personal taxes and mainly in the income tax only, ignoring other taxes that have small contribution. In considering the classical view of fiscal policy, it is convenient to begin with government spending. Like a firm or individual, the government also faces a budget constraint. That is, the expenditures should not exceed the income. The government has three sources of funds: taxation, selling of bonds to public, and creating new money. Therefore, to increase government spendings, additional sources must come from either of the three options. For now, to avoid bringing in a monetary policy change, we assume that money supply is fixed and discuss the increase in government spending financed by selling bonds and by changing tax rates one by one. As per classical economists, an increase in government spendings financed through selling of bonds will not affect variables like real output level or employment level in the economy. To understand why they think so, we have to study how a change in government spending affects the interest rate. As we discussed earlier, the interest rate, according to classical economists, is determined by the demand and supply of loanable funds. The demand is termed as investment and supply as savings. Let us assume that credit market is in equilibrium at E0 and the interest rate is R0. If the government wants to increase spending by selling bonds, the demand for loanable funds will increase. This will push the interest rate up. This increase in interest rate will result in decreasing private investment, which we call as crowding out effect. This happens because as interest rate or cost of borrowing increases, the investor can only invest in those projects which give higher rate of profit. These are only few projects and therefore the investment decreases. On the other hand, increase in interest rate makes saving more attractive. Households cut their consumption expenditures and save the amount to earn higher interest and thus increase future consumption. The increase in government spending is matched by decrease in investment and decrease in consumption. Therefore, the aggregate demand remains the same. So, the level of output and thus the employment level and prices level also remain the same. The figure shows that decline in consumption, which is equal to the amounts of increased saving represented by distance A, plus the decline in investment represented by distance B, equals the amount of increase in government spendings. Second, the tax policy. We shall analyze the tax policy effects from both demand and supply sides. Demand side effects. Studying from demand side, the analysis of a change in taxes produces results similar to those of government spendings. For example, if government decreases tax, which result in increasing the disposable income of the household and leads to an increase in consumption expenditures of the households. However, this will also result in decreasing government revenues. If government sells bonds to replace the revenue lost, the same crowding out process would repeat as in case of bond financed increase in government spending. The equilibrium interest rate will rise, investment will fall, and there will also be an interest rate induced rise in saving, meaning that consumption would fall back towards the pre-tax cut level and the aggregate demand would not be affected. If the revenue lost because of tax cut were replaced by printing new money, then money creation would increase aggregate demand and the tax cut would cause prices level to rise. However, there will be no effect on real variables. Now, the supply side effect. If tax cut were a lump sum tax cut, meaning a flat decrease in tax amount, then it will have demand side effects only. But if government cuts income tax rates, that will have supply side effects as well. Suppose government decreases tax rates. This will increase the take-home wages of the households. As a result of increased incentives to work, the labor supply will increase. This will result in rising the employment level and thus the level of output in the economy, as shown in the figure. Moreover, this will equivalent to rightward shift of vertical aggregate supply curve. Now, the monetary policy. In classical system, the quantity of money determines the price level and the level of nominal income. However, the quantity of money do not affect the equilibrium values of real variables in the system, that is, output, employment, and real interest rate. That is all for today's lecture. In the next lecture, we shall start discussing Keynesian thought about determination of income and employment in the economy. Please post your questions and give your feedback in comments. Also consider liking and sharing the video and subscribing the channel. Thank you and goodbye.